I got a $14,000 raise. I only kept $700 a month. I got the promotion. $14,000 more a year. I told my parents. I told my friends over dinner. For one night, everything felt like it was finally working. Then the first paycheck with the new salary hit my account. And somehow, impossibly, it felt smaller than the one before it. Not on paper. On paper, I was making more money than I'd ever made in my life. But I sat there refreshing my banking app, doing the math over and over, positive I'd made a mistake. Positive that maybe the promotion was actually a trap, that maybe the tax bracket had eaten the raise, that maybe I'd have been better off staying exactly where I was. Here's a number that should stop you cold. The average person who gets a raise overestimates how much of it they'll actually take home by 20 to 30%. Not a rough guess, a documented, repeatable, predictable error. Which means if you've ever felt cheated by a raise, you weren't imagining it, and you weren't bad at math. You were given the wrong number to do math with in the first place. My name is Finn, and I spend way too much time thinking about money and why the system quietly punishes people for not understanding how it actually works. If you've ever felt like getting ahead somehow made you feel further behind, stick around, because by the end of this video, you're going to know exactly where that money went, exactly how to stop it from happening again, and exactly what to do with every dollar of a raise from the moment it lands. Here's what almost everyone believes. They believe that crossing into a higher tax bracket means your entire salary retroactively gets taxed at that higher rate. That the moment you cross the line, from say $94,000 to $95,000, the whole paycheck takes the hit. That belief is completely wrong. And it might be the single most expensive misunderstanding in personal finance, because it's the reason people turn down raises, avoid overtime, and negotiate against themselves in salary conversations they should be winning. The U.S. tax system works in layers, not as one flat rate slapped onto your whole paycheck. Picture your income as water, poured into a stack of cups. The first cup fills at the lowest rate. Once it's full, the overflow spills into the next cup, taxed a little higher. Only the water in the very last cup, the newest bit you poured in, ever touches your top rate. The cups underneath never change. So if you move from the 22% bracket into the 24% bracket, you are not paying 24% on everything. You're paying it on the sliver that crossed the line. Mathematically, a raise can never make your paycheck smaller. Never. So if the tax bracket isn't the villain here, what actually is? Stay with me, because the real answer is more expensive than the myth, and it has almost nothing to do with the IRS. Let's run real numbers. Say I was making $84,000 a year, almost exactly the U.S. median household income. I get promoted. New salary, $98,000, a $14,000 raise. On paper, a 16% bump, something to genuinely celebrate. Here's where the money actually goes. Federal income tax takes a bite first. On that additional $14,000, the marginal rate lands around 22 to 24%, depending on filing status. Call it $3,200, gone, straight off the top of the raise. State tax, if you live somewhere that has one, takes another 5 to 7%, another $800 to $1,000. Then there's the one almost nobody accounts for, FICA. Social Security and Medicare together take 7.65%. No deductions, no exceptions, no negotiating. On $14,000, that's another $1,070 quietly gone before you ever see it. Here's a stat that should genuinely bother you. Over 60% of employees don't know their exact FICA withholding rate. It's not hidden, it's printed on every single pay stub you've ever received. Most people have simply never looked. Then it gets sneaky. Your health insurance premium. A lot of employers scale your contribution to your salary tier, or your raise nudges you past a subsidy threshold you didn't know existed. That can cost another $50 to $150 a month, $600 to $1,800 a year, and it is almost never explained to you when it happens. And if your new salary pushes household income past certain lines, you can lose eligibility for credits you were counting on. The child tax credit phases out at higher incomes. Certain education credits vanish entirely above specific thresholds. Not dramatic cliffs, just quiet, permanent reductions in what actually lands in your account. Add it up, and out of that $14,000 raise, somewhere between $5,000 and $6,000 evaporates into taxes, FICA, and adjusted benefits before you ever touch it. That leaves roughly $8,000 to $9,000 in genuine additional take-home pay for the year. Divided across 12 months, that's about $700. $700. Sit with that. Not the $1,167 a month I was mentally spending the day I got the offer letter. That gap between the number I imagined and the number that actually showed up is the entire source of the feeling. It's not a myth. This is not an opinion. This is just math being cruel quietly in the background while you're busy planning what to do with money you never actually had. But here's where it gets worse, and this is the part that actually drains people, not the taxes. What happens next? I did what most people do. I mentally spent the raise before it arrived. Moved to a slightly nicer apartment because now I could afford it. $360 more a month in rent. Upgraded the car lease, another $180 a month. Started ordering takeout twice a week instead of once, because I'd earned it, right? A new, I deserve this clothing budget, another $100 a month. Added up, $800 a month in new recurring spending, decided in the first 2 weeks after the offer letter, before a single new dollar had actually landed in my account. Remember the real number? $700 a month. I had spent more than the raise before the raise had even fully materialized. And 6 months later, I was checking my bank balance with the exact same anxiety I'd had before the promotion, except now attached to a bigger salary and a smaller margin for error. Let me walk you through what this actually looks like when you run it against a real budget, because the abstract version doesn't hit the same way the specific one does. Take a household bringing in that new $98,000. After federal tax, state tax, FICA, and a modest retirement contribution, take-home lands around $6,200 a month. Rent on a reasonable one-bedroom in a mid-sized metro, $1,600. Car payment, $420. Car insurance, $140. Gas and commuting costs, $160. Student loan payment, $380. Health insurance premium beyond what the employer covers, $210. Groceries for one person trying to eat like an adult, $450. Utilities, electricity, water, internet, phone, $220. Add it up, and you're at $3,580 in fixed monthly costs before a single discretionary dollar is spent. That leaves $2,620 for everything else. Sounds comfortable until you remember that this is the same person who, immediately after the raise, added $800 a month in new lifestyle spending that didn't exist 6 months earlier. Suddenly, that comfortable cushion is thinner than it looks on paper, and any single unexpected expense, a car repair, a dental bill, a rent increase, turns the raise into a wash instead of the win it was supposed to be. Would you have caught that gap before it cost you $800 a month? Most people don't, and it's not because they're careless. It's because of something happening inside your brain that you were never taught to watch for. And once you understand it, you'll never look at a raise the same way again. Let me show you what this looks like on a real household, not just a single person, because the math gets even more brutal and even more common once there are two incomes and a lease involved. Meet the Reeses. Two working professionals, combined household income of $160,000 after her recent promotion added $22,000 to what they were making the year before. On paper, they should feel like they're winning. Let's watch what actually happens. After federal tax, state tax, FICA, and their modest retirement contributions, they're taking home around $9,500 a month combined. Their mortgage on a reasonably priced house runs $2,200. Property tax and insurance add another $550. Two car payments because they both commute, $760. Car insurance for two vehicles, $220. Gas, $280. Student loans between the two of them, $540. Health insurance premiums beyond what their employers cover, $390. Groceries for a family trying to eat reasonably well, $720. Childcare, because they have a toddler now, $1,400. Utilities, $390. Added up, $7,950 a month in fixed costs, before a single discretionary dollar. That leaves $1,550 for everything else. Clothing, entertainment, car repairs, medical copays, and any concept of saving for retirement beyond that modest contribution already counted above. Now here's what happened the month after her raise came through. They didn't do anything reckless. They didn't buy a boat. They upgraded their toddler's daycare to a program with more enrichment activities, an extra $200 a month, because now they could afford it. They started a weekly date night, $160 a month, because they'd both been working so hard they deserved it. They bumped their streaming and subscription bundle up a tier, $40 a month, without really noticing. $400 a month in new spending, decided within weeks of the raise landing. The real after everything increase to their monthly take-home from her $22,000 raise was about $1,100, which means they still came out ahead technically, but they came out ahead by roughly $700 a month instead of the $1,100 they actually earned, and neither of them could tell you where the difference went if you asked them today. These aren't irresponsible people. The Reeses don't have a boat. They've never taken an extravagant vacation. They are two professional adults who did everything they were supposed to do, who got a genuine, well-earned increase in income, and who still ended up with less breathing room than the raise should have given them, simply because nobody ever showed them the real number before they started making decisions with the imagined one. This is what happens when you make lifestyle decisions based on gross salary instead of the real after-everything number. It doesn't require carelessness. It only requires nobody ever teaching you to check. It's called hedonic adaptation, one of the most well-documented patterns in behavioral psychology. Your brain adjusts to a new standard of living astonishingly fast, usually within about 3 months, and then treats that new baseline as the normal it needs to protect and defend at all costs. The emotional high of the promotion fades quickly, but the spending decisions made while riding that high don't fade. They become permanent monthly obligations attached to a temporary feeling that was gone by the second paycheck. Researchers studying financial behavior have found something else that's genuinely unsettling here. People don't just misjudge their raise once. They recalibrate their entire sense of what feels normal to spend, permanently, based on the gross number, not the real one. This is why lottery winners and people who receive sudden windfalls so frequently end up back where they started within a few years. It's not that they're bad with money. It's that the human brain treats a bigger number as a permission slip before it's confirmed the real, after-everything number that's actually available to spend. Here's the part that should genuinely unsettle you further. Car dealerships, apartment leasing offices, credit card companies, they know the exact week you're most likely to say yes to a bigger monthly payment. It's the week after a promotion. It's baked into their sales training. Nobody in that room has an incentive to sit you down first and explain marginal tax rates or FICA withholding. They have every incentive to let you believe the bigger number is the real number, because that belief is what gets you to sign. This is the same mechanism, by the way, that explains why the person driving the brand new truck 2 streets over from you probably isn't wealthier than you are. They just crossed this exact bridge at this exact moment with this exact blind spot, and nobody stopped them either. And here's a statistic that puts the entire pattern in perspective. Household savings rates in the U.S. have hovered around 3 to 5% for most of the last 2 decades, even as median wages have risen substantially over that same period. If people were doing the real math on every raise, that number should be climbing steadily as income grows. It isn't, which tells you this isn't a knowledge problem limited to a handful of unlucky people. It's a structural blind spot built into how the human brain processes a bigger number before it's confirmed the real one. So let's talk about what actually breaks this cycle, because understanding the problem without a plan just leaves you more anxious, not less. First, calculate your real number before you spend a single dollar of the raise. Take the gross increase, subtract 30 to 35% for combined federal tax, FICA, and state tax if it applies. Then check whether it shifts your health insurance tier or knocks out any credits you were relying on. That remaining number, not the gross raise, is your actual new budget. Write it down. Put it somewhere you'll see it before you make any decision involving the word afford. Second, wait 1 full pay cycle, ideally 2, before making any new recurring financial commitment. No new lease, no upgraded car payment, no new subscription tier on anything. Let the real number actually hit your account and sit there for 30 to 60 days before you build a lifestyle around the number you imagined on the day of the offer letter. This single rule alone would have saved me $800 a month, every month, for the better part of a year. Third, automate half of the real increase directly into savings or investments the moment it appears, before it ever touches your checking account. If your real monthly increase is $700, set up an automatic transfer of $350 into a retirement account or a low-cost index fund the same day your paycheck lands. You genuinely cannot spend money you never see sitting in your checking account. This is the entire secret behind people who consistently save more even when they don't earn dramatically more than everyone around them. Fourth, if the raise unlocks new employer 401k match room or pushes you into eligibility for a backdoor Roth contribution, capture that first before any lifestyle upgrade at all. Employer match is still the highest guaranteed return you will ever be offered in your financial life. A 50% instant return on your contribution up to the match limit beats every other use of that money, including the nicer apartment, every single time. Fifth, and this one matters more than people expect, separate the emotional reward of the achievement from the financial decision about the money. You earned the promotion, celebrate it, but celebrate it with something that ends, not something that recurs. A nice dinner ends after one night, and the memory lasts. A car lease follows you for 3 years, whether or not the feeling that justified it is still there. Sixth, and this is the step almost nobody talks about, revisit your real number every time your expenses change, not just when your income changes. If your rent goes up, if you add a dependent, if your insurance premium increases, that $700 cushion can quietly shrink to nothing without a single new purchase decision on your part. Treat your real number as something you check quarterly, not something you calculate once and forget. Here's what nobody tells you when you get promoted. The title is real. The accomplishment is real. Nobody is taking that away from you. But the number in the offer letter was never the number that was actually going to show up in your life. And the gap between those two numbers is exactly where a lot of hardworking, intelligent people quietly end up feeling poorer while technically earning more. You weren't imagining it, and you weren't bad with money. You just did the math with the wrong number. Everyone around you is doing the same math with the same wrong number, which is why this feeling is so common and so rarely talked about, honestly. Do it with the right one next time. And that same $14,000 raise stops being a trap and finally becomes exactly what it was supposed to be in the first place. Not a bigger number to feel good about for one dinner conversation with your parents, but a real compounding foundation that actually changes your life 5, 10, 20 years from now. Your future self is counting on the decision you make with this raise. Not the one you imagined you'd have,